Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Missy Dolski, Partner and Global Head of Asset-Based Finance at Värde Partners. Missy, it's nice to see you again. Thank you for coming on the show.
Thank you.
Of course, yeah. And looking forward to our conversation.
Me as well. Thanks so much.
Of course. So, just to start, I know as your title says, Global Head of Asset-Based Finance. So how does Värde think about asset-based lending? And in today's environment, which is obviously hyper-competitive, how do you differentiate yourselves from others?
Yeah, it's a great question. Well, again, thanks for having me on, Todd. I'm super excited to be here.
Course.
So Värde has over a 30-year history in and around the credit markets. I think our experience in what we call ABF has evolved a lot over our history. We've invested over $13 billion in the space since 2008. And I think our history in the space really suits us well to where we find opportunity in how we differentiate ourselves today. So if I just rewind back the clock a little bit, coming out of the GFC, we were very much a kind of opportunistic, distressed player in and around these asset classes. We were buying a lot of assets out of banks. We were large in the putback trade post GFC. That evolved into we were an owner and operator of many non-bank origination platforms. Some of those platforms we bought out of banks. And so that experience and kind of really understanding how these lending platforms work has suited us really well. And if I fast forward to today, in a post-COVID world, and this is the case for a number of lending strategies at Värde, we really are focused on kind of scaling performing credit within ABF. And so I think our history in this space, again, suits us very well to really understand these asset classes in a deep way that not everyone can say that they do in the same way. So today, the way we think about ABF is we really set ourselves up in three main verticals. We have a consumer finance vertical, we have a commercial finance vertical, and think about those as your more traditional granular ABF type of asset classes. So consumer would be things like, auto loans, student loans, home improvement loans, et cetera. Personal unsecured loans. Commercial would be things like equipment leases, small balance SME lending, supply chain, things like that. And within those verticals, we really approach the market with our asset class expertise. And so we get to know our clients. We have the ability to buy loans from them. We can finance their loans. We can lend to them directly at a corporate level. So we have a lot of tools in the toolkit, and it's very much a solutions-oriented approach, which I think is very much appreciated. And again, going back to our history in the space, our counterparties on the other side really feel that we understand their businesses. And then the third vertical we have within ABF, which I also think is a differentiator, is a focus on fund finance. And we can kind of talk more about that a little later, but
Yeah.
that's a real growing area that we think fits very nicely into what we're doing in ABF more broadly.
And overall, you guys are more active or more focused in the middle market. Why is that? Why haven't you gone upstream like maybe some others? What makes that piece of the market most attractive to Varde?
Yeah, it's a really good question. So, I mean, I know ABF is a very much a hot topic lately. There's been a lot of capital that's come in, a lot from very large managers who are very much focused on that upper end. And when I say upper end, I really mean larger ticket size deals
Yeah.
of the market. And I think you end up being very much a price taker when you start competing in very, big pockets of capital like that. I think if you go back to our approach, it's very much aligned very well more to the middle market. We can work with companies and grow, offer solutions to them and grow with them. And then, by the way, we get paid outsized spread along the way to do that. And what we found is as those platforms grow, and so these will be platforms that, maybe they haven't accessed the securitization markets yet, or they have, but they're entering a new geography or they're offering a new product. And we can kind of help be a capital provider as they're taking on those initiatives. And even as they become more well established and may attract the likes of the larger, deeper pockets of capital, it can be very sticky business because we become a trusted partner to them. So I think that's a little bit why we find that middle market space a lot more attractive. And think about that space as kind of like 50 to $150 million ticket sizes is the way I really define that.
And when it comes to, maybe specific segments of the market or industries that are kind of most compelling today, what might, be some of those? And then when it comes to sourcing some of these opportunities, maybe talk a little bit about sourcing
Yep.
and where some of the most compelling areas of the market are today.
Yeah, definitely. So if I go back to the three main verticals that I mentioned that we have, I mean, I'll start with commercial finance. So we have really deep history in and around kind of the SME, small balance space. We've done a lot with some of the merchant payment processors. So these would be like when you go to your coffee shop and swipe your card.
Yeah.
The providers of those devices are often have lending programs to a lot of those small businesses. And so we've been a capital partner to those. We like that space a lot. Equipment leasing is another big area of focus for us. We just closed a transaction in December in Germany of a handset leasing platform that also provides device as a service. There's a lot kind of going on in the broader continent in Europe around equipment. And then obviously it's a very deep market in the US too. I think it speaks really well to being backed, some of the benefits of ABF being backed by hard assets. So we like the equipment space a lot within the commercial space as well. I would say, things like trade finance, we're a bit more cautious on in this market right now, right? There's a lot of noise going on in the market, albeit, there's some opportunities there as well. Within consumer, obviously a very big area.
Hmm.
We're pretty thoughtful on the consumer right now, particularly the US consumer. The nice thing about being able to offer different products, if you will, products being like being able to buy loans and or finance loans, is we can kind of choose where we are in the capital stack. So, we're very cautious right now about taking first loss consumer risk in the US, albeit for more prime consumers who are also homeowners. We're
Hmm.
actually seeing, performance there holding up pretty well. Those are the types of areas where we're a bit more willing to lean in. Um, but we're also seeing just a lot going on in the home improvement sector more broadly in consumer, as a lot of service providers of home improvement needs for folks are starting to build out their own captive financing programs, and they need capital partners to do that. So a lot of interesting things going on in that space as well. And then in fund finance, again, we can get into this, but our fund finance strategy really takes on two flavors. One is being a capital partner to banks participating in their subscription lending programs. The reason we think that's attractive is that's $1 trillion plus asset class, largely sitting in the banking system today, that is ripe for a capital markets and non-bank solution to it. We've been a
Mhm.
real first mover in cracking how to play in that space. And then on the back of that, we're then able to offer those same GPs, more higher yielding type of fund financing solutions, things like NAV loans, GP commitment financing. So we think that's a really interesting sector as well. To your question on sourcing and how we do that across the space, we have a team of senior originators who have been kind of in and around these asset classes for decades. Over 50% of our flow or our investments are sourced directly, and that's just direct relationships with, the underlying platforms that we're doing business with. Away from that, decent amount comes through the banking sector. I used to run capital markets at Värde, so we have really good inroads with a lot of banks who are running processes around bringing capital like ours into deals. Advisors obviously is another, and so we're very just front-footed in and around where kind of deal flow is happening. But back again to the middle market point, so much of this is a relationship business at the end of the day, and sourcing direct is and always will be kind of the best outcome for us.
As a follow-up, to the fund finance, ABF, like, do you view fund finance as kind of becoming a market unto itself? Is it kind of related to ABF? Like, it feels like for a long time it's been kind of pieces of other markets, but it's kind of shifting into maybe its own category today. Is that kind of
Yeah.
the trend that you're seeing as someone who's playing in both spaces?
Yeah, it's a really good question. It's a little bit like how for the longest time when people use the term private credit, they only thought about direct lending.
Yeah.
And in reality, when you start peeling that back, there's so many things that encompass private credit, right? And so, one of the questions we always get is like, how do you define ABF? And so, because everyone defines it a little different. Some people would
Yeah.
put real estate lending in ABF. We love real estate lending, but we have a separate, real estate lending vertical, if you will, that does that separately. So I think part of it is just a little bit how everyone defines this. We just got back from the Fund Finance Conference in Miami last week. You rewind back 5 years ago, that was a conference of bankers and lawyers, slinging sublines around. And
Yeah.
now it is such a multifaceted conference around all these different products, all different types of capital. So I agree. I think it's that space is becoming in and of itself a very large standalone sector, but it dovetails a lot with ABF, just given a lot of the characteristics of what it looks like. When you think about the sources of repayment, for a lot of those loans, you're backed by contractual cash flows. So it has a lot of similar characteristics, which is why for us, it sits within our broader ABF vertical.
You're going back to, the ABF and kind of what it takes to be successful today, and how do you avoid maybe some of the pitfalls? Obviously there was a
Yep.
couple of names that had come up late last year that certainly took a lot of the oxygen in terms of the news, and then the term cockroaches obviously was thrown out there as well. But how do you avoid some of those pitfalls, and continue to be successful kind of where you guys play?
Yeah. I mean, I think it's funny. I made this comment about ABF getting a lot of attention. And a lot of capital coming in. There's a lot of people moonlighting as ABF investors right now who don't, I would say, have the deep expertise in how some of these asset classes work and
A lot of
understanding
tourist investors, right?
of what those pitfalls could be. Yeah. I mean, it's a
Yeah.
really important um, the way we're set up is we have a team of 11 data scientists that and we work with them that for each underlying asset class that we are making an investment in, we have different KPIs per asset class. So you really kind of have to understand the drivers of the underlying assets, and then kind of set yourself up in a way where you can monitor that in the right way. And it's not just monitoring the cash flow performance, it's also the setup of how these types of deals work. So for instance, something as simple as if you're going to have multiple, if a platform has multiple, warehouse lines with mezzanine providers like us in their structure, there needs to be the same custodian on each of those lines to make sure loans aren't being double pledged to different lines. And that needs to be checked every time an advance is made. So, we really take a lot of pride in our diligence process, which really comes from a deep understanding of how these asset classes work. I think that becomes super important. And when you think about some of the issues that the industry has faced around this, a lot of it was driven by outsourcing of a lot of that diligence and a loss of kind of the data checking of getting ahead of some of those issues. Now, fraud can be just like a really hard thing to prevent,
Yeah.
obviously, but you have to have processes in place to catch it early. Otherwise, it can be very pervasive. And so, to me, when I think about um, what it takes to be successful, these are current income strategies, right? So we're not sitting here investing, trying to meet 20-digit, or 20% returns. Like the whole point, there's a lot more downside. So really understanding kind of the downside and which is why we like this asset class altogether, because you can structure for it, but you kind of got to know what you're doing, I guess
Yeah.
is my point.
You obviously referenced the data science piece. If you could maybe dig in a little bit further on that, what does that look like in practice?
Yeah.
And then ultimately, when it comes to accessibility and quality of data, how does that vary lender to lender? Like data equal? If it isn't equal, how does that play
Yep.
into it? Maybe tell us a little bit more about the data science piece.
Yeah, it's a really good question. So, like I mentioned, we have a team of 11, and their job really is when you think about the granularity of some of these programs, you're getting oodles and oodles of data thrown at you. And so we're set up in a way where underlying platforms can feed tapes directly into Värde systems. And then our team of data scientists basically takes all that data and puts it into formats that are very consumable. So we have dashboards with specific KPIs by the different asset classes, as I mentioned. And what we're really trying to do at the end of the day is understand what is the data telling us relative to what's the qualitative narrative that the management teams are telling us. And you're kind of trying to make sure those match up. And you'd be amazed how many times a platform will kind of say one thing, but the data doesn't tell that same story. And if we can't reconcile those two things, we can't do the deal.
Yeah.
This gets back to really understanding the business, understanding the performance of all the vintages, and being really eyes wide open about, because it's what allows you to kind of run very realistic stress scenarios on a go forward basis for some of the performance of these asset classes. And so that's really what we're trying to do with that data team is be able to tell the right story around and getting our heads around the risk that we're taking. Super powerful.
Pivoting more to fund finance, obviously we've touched on it a little bit a few moments ago, but it's clearly a growing area of the market. You referenced obviously one of the larger events in the space, what it looks like today compared to 5 years ago. You guys launched a fund finance platform in partnership with a global bank. Tell us a little bit more about that. How does that
Yep.
fit to ABF strategy? And a kind of a secondary question to that is the traditional bank piece of the market now blending more with the non-bank piece, and is that kind of where this market is kind of heading over the next few years?
Yeah, it's a really good question. So I mentioned briefly, but our fund finance platform really takes on kind of two flavors. One flavor we have dedicated capital for. It is a program where we are a capital partner to banks participating in their subline lending programs. And why are we doing that? We're doing that on the basis of, and this was a thesis we formed a couple of years ago, on the back of really our experience as a borrower, experiencing the whipsaw, if you will, that can be bank balance sheets around some of these products that as a GP you rely very heavily on to run your business.
Yeah.
So as I mentioned, this is a $1 trillion plus asset class, largely sitting in the banking system, growing at the rate that private capital is growing, right? Like 8 to 10% per annum. There must be a way to distribute that risk more broadly into the non-bank lending market. Banks will always have to provide that product. It is highly valued by their GPs. It's actually a really good product for bank balance sheets. They just need to be thoughtful about how much they can do of it and how they can show velocity of their balance sheets as they're originating it. So that's really a lot of the thesis for us, was not to compete with the banks in it, but to be a capital partner to them. So that's what we announced for the partnership you had mentioned. We're super excited about it. Right now, what we're experiencing is banks have a lot of balance sheet to put to work right now. There's been a lot of regulatory rollback, a lot of capital released. And so that perhaps hasn't scaled quite at the pace we thought it would. But we feel really good about all the plumbing we've built to be in a position where when bank balance sheets do need to pull back, which they eventually will, they always do at some point, we'll be really well positioned to take advantage of that in the market.
And
And
I mean, that was going to be my secondary, another question to that. I mean, it's not like we're going back in time where banks are gonna all of a sudden, like they have in fintech, like they've taken a back seat where they provide a lot of the financing, but the platforms are now the actual customer facing interface.
yep,
It's not like the same thing in fund finance. It's not like they're going to go back in time and eliminate the partnerships that they've now cultivated, because, like you said, eventually they're going to have to pull back, especially
yep,
the regulatory environment
yep.
will change, even if it's healthier for banks today and their balance sheet.
Yeah, I agree with that. But I would say that what you had mentioned about banks and the other asset classes becoming more of a financier, we'll see that as well with this asset class, meaning particularly for the US banks, right? For them to originate a subline loan directly, that's 100% risk weight asset. If they can finance someone like us who's originating that loan or who's directly made that loan, that's a 20% risk weight. So same exposure, better attachment point. They'll benefit from cross collateralization of those loans. It's a new business line for them. And then, by the way, they can help us securitize that product and create a fee income stream for themselves, on the back of the securitization of the product as well. And so I think we're going to find banks will stay in that business from a direct origination perspective, but you'll also see banks build out financing businesses related to the product as well.
Then in terms of, kind of what to watch for in growth and innovation, which markers, kind of look at sustained growth in ABF, whether it be bank partnership flow, insurance allocation, securitization capacity. And you could probably relate some of this to fund finance as well, because it seems like some of these same trends are coming to fund finance, more
Yep.
securitization like structures, obviously insurance capital playing a big role in that market as well.
Yep. Yeah, I mean, I think it's all the above. I made the comment about how people define private credit. I think ABF is now kind of a mainstay feature of private credit. And I guess why is that? That's because, driven by the advancements in technology, the way consumers and small businesses access credit, right? You have all these fintech platforms that need capital, right? The amount of it's not that banks aren't doing that lending business, but a lot of it is being done outside of the banking sector now too. It's making its way into the securitization markets, which it has been for a really long time. But you're just continuing to see the expansion of the pockets of capital providing these types of this type of access to credit. And I think that's what's kind of making it more mainstay, particularly as it relates to how LPs think about their ability to access the product.
Speaking of LPs, where are we in terms of, the LP adoption of ABS as an asset class. There's lots of different LPs out there. Insurance, I think, is clearly adopted many of these, and
Yep.
we've seen that taken off the last few years. But what about pensions, endowments, sovereign wealths?
Yep. Yeah, I mean, we at Värde, our LPs are asking for this exposure. They particularly, and again, and you're starting to see it now even in private wealth, right? People want diversification away from direct lending. That space has gotten very big.
Yeah.
They like a lot of the attributes of ABF. They like the downside protection of the how deals are structured, the fact that you're backed by hard assets. They like the current income nature of it, the fact that you can get way more ahead of issues with the regular access to data than you can by waiting, 45 days post quarter end to get a cash flow update from an underlying corporate. And so, we have changed our product offering then to be able to offer to LPs very dedicated exposure to this asset class. And so I think the demand from LPs is very high right now. And there's a little bit of tailwinds we're riding, if you will, around LPs really kind of looking, actively seeking out this type of exposure. And to your point, it's, insurance obviously fits very well given the ratable nature of a lot of these capital stacks,
Yeah.
but it's broader than that. It is your more regular way, kind of broader, pensions, endowments, sovereign wealth, et cetera, who are actively seeking this type of exposure.
What's the biggest question LPs might ask? Is it, a negative, something happens negative in the news, or anything else that might, kind of pique their interest and say, hey, we really like to learn more about this? Is there one particular trend?
Yeah, I mean, it's always changing. I will say the number one question we always get, and we try to just front run it almost, is how do you define ABF? Because I think,
Yeah.
these LPs now are talking to a lot of managers. Everyone does it a little differently. And then the next very follow-on question is like, what is your competitive advantage? How do you scale? How do you source? There's more capital coming in. And I think we have a really good story to tell around, our middle market focus, the deep relationships we have in the space, our history in and around a lot of these asset classes. And so I think a lot of that resonates. But then they'll always pick up on the topic of the day, right? The cockroaches was a topic for a long time. What's going on in kind of the software space right now is very topical,
SaaS
even though like,
apocalypse is what people have started to term
yeah,
it
I
as.
mean, we don't really, the way if you think about our focus for ABF, it's a bit irrelevant. But again,
Yeah.
because everyone defines this a little differently and everyone's box is a little different, different people are going to have different types of exposure.
So we have a few minutes left. I like to always end with a little more fun, rapid fire questions. So do you have a favorite sports team and or hobby?
Well, I grew up 30 minutes outside of Green Bay, so I'm a bit of a diehard Packers fan, I
Yeah.
will say. I went to my first game at Lambeau when I was in kindergarten,
Wow.
um, and have gone every year since except two. So,
Impressive.
um, Packers all the way.
Tell us one surprising thing about yourself.
Um, Despite having grown up in a town of 2,000 people, I have traveled to over 70 countries. It's a
Wow,
fun fact.
70. Wow.
Yeah,
That's a lot. Is it mostly business related or
mostly fun.
mostly fun?
Yeah.
Wow, that's great.
I would say everyone should live in Europe in their early 20s when they have flexibility to travel. Would be my suggestion.
What's the most I guess off the beaten path place that you've been?
Off the beaten path.
I mean,
I
70 is a
don't
lot
know.
of countries, so
Yeah. What's the most off the beaten path? I've been to like Ecuador and the Galapagos. That's pretty cool. Bali, New Zealand is I skydove over the Fox Glacier in New Zealand. That was
wow.
pretty amazing.
That's pretty cool.
I haven't done, ironically, it's a high number, but Africa is very, very untouched for me. So that's my
Goals. Next goals.
retirement bucket list, if you will.
One book that you'd recommend reading.
I'm a terrible reader, mostly because I'm going to blame my small children and my lack of time.
I
Um,
can understand that.
the one book that I just think everyone should read because it keeps me grounded. I've read it more than once, is The Road Less Traveled. It's a very good book around just keeping life in perspective.
Most exciting part of your job.
Um, just building and growing something. I have an amazing team. Um, yeah, we've got a great story to tell here, and I get really energized by my job.
It does certainly come through the screen. I can tell you that. And then one final question is one prediction for the next 12 months.
Um, I would say if the last 12 months have been any indicator, we're going to see more noise in the headlines. That is one thing this administration is guaranteeing, I think. Um, but I do think if you look at the markets over the last 12 months, they've ignored a lot of those headlines largely. I think we might see that change this year. I think you can see some pullbacks in the markets. But so that would be my one prediction, and it's a little bit why we like the asset classes we play in. We feel good about our ability to structure and underwrite around some of that performance risk.
That's a good place to leave it, Missy. It's great to see you. Thank you very
Yeah, you as
much
well.
for your time.
Thanks.
Really appreciate it. Continued success, and hopefully we'll get you back sometime in the future.
Sounds great. Thanks so much, Todd.
Yep, thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.